Welcome to another case study by Blueprint to Escape. We're just incredibly excited to have you with us today.
Yeah, we really are.
Because today's case study is a highly specialized guide aimed squarely at you, the North American investor who is looking to geo-diversify outside of the US and Canada in 2026.
Right.
And I have to say right up front, this isn't just some random topic we pulled out of thin air. This specific case study was entirely driven by community demand. You asked for it, and we're delivering. We're focusing on a truly fascinating region of the world today, Southeast Asia, and specifically the ASEAN countries.
It's a brilliant suggestion from the community, honestly, and the timing really couldn't be better. I mean, if we look at the current landscape, we're sitting in a market that feels completely dominated by U.S. mega caps and the endless exhausting cycles of Wall Street.
Oh, absolutely exhausting.
Right. And a lot of investors right now are actively searching for what our research beautifully calls stoic wealth tranquility.
I love that phrase, stoic wealth tranquility.
It's great, right? They want growth, yes, but they also want stability away from all that noise.
Yeah.
They want to sleep at night without worrying what a single earnings report from a tech giant is going to do to their entire net worth.
Exactly.
But before we get into how Southeast Asia might actually provide that tranquility, I do need to set the stage with some very important housekeeping. Please remember that this case study is purely for educational and entertainment purposes. We are not giving financial, tax, visa, or investment advice. You always need to do your own research and consult with a licensed professional before making any moves.
Essential disclaimer there.
Always. Also, I want to be crystal clear that any companies or ETFs we mention today are not sponsors of our show. In fact, we haven't even invested in the specific ETF we'll be discussing today.
Yeah.
For us, building this case study has been purely a learning journey right alongside you.
Yeah, and because this community is the engine behind what we do, I want to remind you right off the bat, please post comments or questions and subscribe for more content about financial independence, passive income, early retirement, and nomadic life design. We absolutely love hearing from you and shaping our content around your goals.
We really do.
Also, a quick tease for you. Make sure you stick around and watch out for our updates because we reveal our personal monthly income portfolio around the 20th of each month, breaking down all our major moves.
Well,
Okay, let's unpack this.
let's do it.
The core of today's case study is ASEAN. That stands for the Association of Southeast Asian Nations. We're talking about a powerful bloc of 11 countries boasting a combined population of over 670 million people.
Massive.
Just to paint the map for you, the core 10 are Brunei, Cambodia, Indonesia, Laos, Malaysia, Myanmar, the Philippines, Singapore, Thailand, and Vietnam. And as of late 2025, we have the newest addition to the bloc, which is Timor-Leste. It's this incredibly diverse mix, right from the massive financial hub of Singapore down to emerging frontier markets.
It is a massive dynamic bloc, and the core thesis of this case study is that these nations offer incredibly unique benefits for an investor seeking that geo-diversification. We're looking at a region characterized by stable growth, bank-heavy economic sectors, and these massive shifts in global manufacturing.
Yeah.
And perhaps the most crucial point for someone trying to balance a North American portfolio is this. These markets have an incredibly low correlation to the volatility of the S&P 500. Think about it. When a major U.S. tech stock misses earnings, the S&P drops. But does a regional bank in Jakarta or a manufacturing hub in Vietnam really feel that shockwave?
Not necessarily.
Right. Not at all. Let's look at that steady regional growth first. The GDP forecasts for the Asia region are hitting between 4.0 and 4.3% for 2026. To put that in perspective, that is absolutely crushing the global average, which is sitting around 3%.
Over a full percentage point higher than the global average. That is huge when you compound it over a few years. But what's actually driving that? I mean, is it just cheap exports?
Not at all. And that's the beautiful part. The why behind that growth is vital to understand. First, intra-regional trade, meaning these countries trading with each other, makes up a full 25% of their total trade.
Wow.
It's like a neighborhood where everyone buys from each other. Just instead of going to the big box store across town, they're building a self-sustaining ecosystem. Second, we're seeing a massive recovery in tourism, particularly in places like Thailand and Vietnam, bringing in tons of foreign capital. And third, the demographics are just phenomenal.
Yeah, the demographics are key here.
Out of that 670 million population, a huge percentage is under the age of 35. That youth is driving a massive sustained consumer boom right at home.
Here's where it gets really interesting, because our research highlights a massive global theme that is directly fueling this region's rise, the China+1 manufacturing shift.
Yes, this is massive.
We've all seen the headlines about supply chain disruptions over the last few years, and multinational companies have realized they just can't have all their eggs in one basket anymore. It's like realizing you've been buying all your groceries from one store that randomly changes its hours, so you finally decide to find a backup supermarket down the street.
Exactly.
So they're adopting this China+1 strategy, keeping operations in China, but heavily diversifying their supply chains into neighboring countries. Look at Apple moving significant parts of its supply chain to Vietnam. Because of shifts like this, Vietnam is seeing a 7% plus surge in exports, largely driven by electronics and textiles, and they are pulling in over $40 billion in foreign direct investment, or FDI.
The numbers are staggering.
And then you look at Indonesia, they're brilliantly leveraging their massive natural resources, specifically nickel, to become an absolute powerhouse in the EV battery boom.
If we connect this to the bigger picture, the numbers are truly paradigm shifting. The data shows that ASEAN has actually surpassed China in both U.S. import share and in global FDI inflows.
That's incredible.
Let that sink in for a moment. Capital is flowing into Southeast Asia at an unprecedented rate. They're capitalizing on competitive labor costs and tariff advantages to become the new global hubs for electronics and tech manufacturing. But they're also tapping into commodity supercycles.
Let's pause there for a second. For someone who maybe isn't steeped in macroeconomics, can you explain what a commodity supercycle actually is?
Absolutely. A commodity supercycle is essentially a prolonged period, often a decade or more, where the demand for raw physical resources vastly outstrips the supply, driving prices steadily upward.
Okay, got it.
So when we talk about Indonesia and nickel, they aren't just selling a metal. They are feeding the insatiable decade-long global demand for green tech and EV batteries. For a North American investor, this offers a brilliant buffer. The returns generated by Vietnam's export surge or Indonesia's nickel boom are completely independent of U.S. interest rate cycles or sudden tech sector corrections. It provides true resilience against potential U.S. consumer slowdowns.
Okay, but anyone looking at a map of Asia right now is probably wondering about the elephant in the room.
Sure.
Because this case study focuses exclusively on Southeast Asia and deliberately excludes the two absolute biggest economic players on the continent, China and India. Leaving China out entirely feels like a massive blind spot, doesn't it? I mean, they're the manufacturing center of the world. Why ignore them?
It's a very fair challenge, and the case study is very clear on its reasoning, which is rooted entirely in analyzing market volatility and the pursuit of that stoic wealth tranquility we mentioned earlier.
Right.
We aren't making political judgments here. We're just looking at the math of risk. Let's break down the exclusion of China first. According to the analysis, there are two primary headwinds that create outsized volatility there. The first is geopolitical risk. We're talking about ongoing trade tensions, the constant threat of new tariffs, and severe export restrictions. In the markets, these act as binary risks.
Meaning a switch flips and your portfolio drops 10% overnight without warning.
Exactly. An event happens, a tariff is announced, and it triggers a sharp, sudden sell-off that is completely uncorrelated with how the broader global markets are doing. The second factor is regulatory uncertainty.
Which has been huge recently.
Huge. The data points to sudden government interventions, like the crackdowns we've seen on major tech firms like Alibaba, or the massive restructuring in the real estate sector with companies like Evergrande. When you combine that with state control mechanisms, like the government holding golden shares in private companies, the unpredictability just spikes.
Let me jump in. For those who might not be familiar with the term, a golden share basically means the government holds a special minority stake that gives them veto power over a private company's major business decisions, right?
That's spot on. And when that mechanism is in play, it can destroy shareholder value essentially without warning. The conclusion of our research today is simply that for an income investor seeking stability and reliable valuations, there's currently too much noise and unpredictability in that specific market for this particular strategy.
That makes a lot of sense if your primary goal is lowering your blood pressure when you check your brokerage app.
Exactly.
But what about India? I mean, we've talked about India's booming economy before on this show. Why leave India out of this particular case study?
India is a fascinating contrast because the data shows India actually possesses incredible fundamentals. We're looking at projected GDP growth of over 7% annually through 2026.
Unbelievable growth.
They're pulling in $81 billion in FDI, with massive investments from giants like Microsoft pouring in $5 billion and Amazon investing $35 billion. That money is largely fueling data centers, AI, and manufacturing. Furthermore, India has a young, rapidly expanding middle class that is projected to reach over 400 million people by 2030. They have pro-business reforms and fantastic demographics.
So if the fundamentals are that strong, why aren't they in the strategy?
Because the case study chose to exclude India from this specific deep dive due to recent negative short-term performance in the Indian markets, and because India is still occasionally subject to some international geopolitical noise.
Okay, I see.
Plus, think about it. If you're a North American investor heavily invested in the S&P 500, you already have indirect exposure to India's tech boom through those massive Microsoft and Amazon investments. While India remains a fantastic long-term compounding play, the ASEAN region simply offers a cleaner, less volatile, and less tech-correlated focus for this specific analysis aimed at income and stability.
All right, so we've established the why of the ASEAN region. Now we need to look at the how. How does a North American investor actually get exposure to this without trying to open a brokerage account in Kuala Lumpur?
Right, which sounds like a headache.
A huge headache. The case study highlights a very specific investment vehicle, the Global X Southeast Asia ETF. The ticker symbol is ASEA. It tracks the FTSE ASEAN 40 index. Let's walk through the vital stats here. It has an expense ratio of 0.65%. Now, that's a bit higher than a dirt-cheap Vanguard S&P 500 fund, but you're paying for specialized international access.
Yep.
True to the strategy we just discussed, it has exactly zero allocation to China, Taiwan, or India. It is a pure play on Southeast Asia. And as of March 2026, it is offering a very pleasant dividend yield of 3.85%.
What's fascinating here is when you look under the hood at the geographical and sector weightings of this ETF, it tells you a lot about the economic reality of the region. Geographically, Singapore dominates the fund heavily, sitting at 46.9% allocation.
Almost half.
Right, which makes sense, as Singapore is a financial and banking hub for the entire region. This is followed by Thailand at 19.8%, Malaysia at 16.4%, Indonesia at 13.0%, and the Philippines at 3.8%. But the sector weighting is where the real story is. The ASEAN ETF is overwhelmingly weighted toward financials, between 58 and 59% of the entire fund.
Almost 60% of the fund is just financials. I have to be honest, to an investor used to high-flying tech stocks, buying a basket of banks sounds a little boring, or maybe even risky if we think back to Western banking crises. Why does that massive concentration matter so much?
It matters because of what you are actually buying and how different it is from your domestic portfolio. When you buy the S&P 500 right now, you're buying a massive chunk of technology. When you buy ASEA, you aren't buying tech. You are buying massive, incredibly stable Asian banks.
Right.
You're buying institutions like DBS Group, which alone makes up 16% of the entire ETF. You're buying OCBC and UOB out of Singapore and major lenders like BBCA in Indonesia. These aren't speculative growth companies. These are resilient, high return on equity lenders.
Let's do a quick ELI 5 on that. High return on equity, or ROE, essentially means these banks are incredibly efficient at turning shareholder money into actual profit. Correct.
Exactly. They are highly efficient, well-capitalized machines. And here is the crucial data point. These banks are growing their lending by 10 to 15% year over year. They are directly catering to that rising Asian middle class we talked about earlier. Imagine a massive young population getting their first credit card, financing their first scooter, taking out their first mortgage, or opening their first wealth management account. These banks capture all of that foundational domestic growth. It acts as the perfect counterbalance to U.S. mega-cap tech dominance, giving your portfolio a foundation tied to rising Asian savings and consumer credit, rather than the boom and bust cycles of Wall Street.
It's a really clean way to play the demographic boom without trying to pick individual winners in the consumer goods space. And, we can talk theory all day, but the proof is always in the numbers.
Always.
Our research pulled recent performance data comparing a 3-month snapshot from December 2025 to February 2026 alongside the 1-year performance. Let's group this data so it tells the story. Over that 3-month period, while giants like India and China were actually sitting in the red, both down about 6%, Southeast Asia, tracked by the ASEA ETF, was up over 8.4%. That's a massive divergence over the exact same 3 months.
It's a stark contrast that perfectly illustrates the concept of low correlation.
Exactly. And over a 1-year period, ASEA is up a fantastic 29.17%. Compare that to India, just under 5%, and China around 10% for the year. We also looked at European banks, ticker EUM, which was up about 3.5% over 3 months and 33% for the year.
Solid numbers there, too.
But the real jaw-dropper in the data was Latin America, ticker ILF. They were up over 14% for the 3 months and a staggering 65.34% for the year. But the real headline for our focus today is that over these recent months, the Southeast Asia ETF completely crushed a flat S&P 500 and a slightly negative NASDAQ.
This raises an important question, and it's one of the most insightful connections made in the case study. If you look at that data, the two absolute standout performers for geo-diversification over the last year were Latin America and Southeast Asia. Why did those two specific regions do so incredibly well while others struggled?
It's a great question.
The research points out a brilliant commonality. Both regions feature fantastic, deeply entrenched financial institutions that are catering to massive, rapidly growing youth populations. Crucially, these are populations that are rapidly transitioning from being unbanked to being banked.
That transition is a massive economic unlock.
It is. Whether it's a young worker in Brazil getting their first formal paycheck deposited, or a young entrepreneur in Indonesia securing a small business loan, they are entering the formal financial system for the very first time. And the banks in those ETFs are capturing every ounce of that foundational economic growth. It's a proven recipe for robust, uncorrelated returns that don't rely on the next big software innovation.
So what does this all mean? If we wrap up all the threads from this incredible case study, it comes down to this. If you're an income and growth investor and your primary goal is to protect your capital while still capturing upside, finding sectors that are entirely uncorrelated to U.S. tech and North American politics is absolutely key.
Very true.
Now, don't get me wrong, things like Canadian banks, business development companies, and utilities might always be the core of your portfolio. But adding a satellite position in the ASEAN region provides that much-desired stoic wealth tranquility. It's a way to participate in global growth, ride the wave of a booming middle class, and capture a 3.8% dividend yield, all without the daily heartburn of checking the tech ticker. I have to say, this whole case study being born from a community suggestion is just fantastic. We learned an immense amount from digging into this material, and we have our listeners to thank for pointing us in this direction.
It truly was a rewarding learning experience, proving that there are always new corners of the global market to understand and leverage, especially when you tune out the loudest noise.
Before we wrap up today's session, I want to deliver one last mandatory reminder to you, our listener. Please post your comments or questions down below and subscribe for more content about financial independence, passive income, early retirement, and nomadic life design. We build this show for you, so let us know what you want to explore next. And don't forget to look out for our mid-month portfolio reveal around the 20th, where we walk through all our major moves to optimize our own stability and income.
I'd like to leave you with a final thought to mull over as you consider the global landscape. We spent a lot of time today seeing how the China+1 strategy has massively benefited ASEAN nations, bringing a flood of foreign manufacturing and capital into places like Vietnam, Thailand, and Indonesia. But as these young, rapidly growing ASEAN economies move up the value chain, as their populations get wealthier and their labor costs inevitably rise, who becomes their plus one? How long is it until we see these currently booming Southeast Asian nations outsourcing their own lower-tier manufacturing to new frontier markets? And perhaps the most exciting question for us as investors is, where will that next great geo-diversification opportunity emerge?